Welcome to Achieve Wealth through value-add real estate investing. This is the show where the guru hype is banned and you get direct insights from commercial real estate operators. If you're a passive investor, this show can help you better understand investment opportunities. And if you're an active investor, the lessons from each episode can help you to become more effective in your own deals.
This webinar was previously recorded and converted to a listening format. Now, please enjoy this timely and valuable market information from expert commercial real estate investor James Kandasamy and special guests.
Beginning here. So depreciation, again, you can either take it over a 27.5 or 39-year period, a little bit each year, this deduction, or you can accelerate that depreciation into these different categories. And how that works, we'll just show a simple example. Okay, let's say you buy a property for $1 million. You always have to take off a certain amount for land. We're going to use 15% here, which is a pretty national average, although it is going to depend. Certain accountants will use like a safe harbor of 20%. Certain areas will, like California, can be up to 50 or 60% land value. And other areas, I've had certain properties where it's even less than 1% land value. So it really does depend on the location. Just use this simple number here. And what's left is $850,000. That's the amount that you can depreciate over that total of 27.5 or 39 years. What that looks like with straight line depreciation. And every single accountant uses this and knows what depreciation is, but they may not know how cost segregation works and how to do this because, as I said, it requires an engineering component to it. And again, if anyone has any questions, please don't hesitate to put them in the chat and we will get to them either now or at the end. And so what we're doing is taking a little bit every year. For straight line commercial property, $21,000 every single year. That's great, right off the top, okay? For residential or multifamily properties, $30,909, right? About $30,000 a year. And again, this is an average and based on that $1 million property. So if you make, let's say, $50,000 from your property, your net income, after all expenses, after debt service, everything like that, you're still left with, even after the simple depreciation deduction, you're still left with a tax exposure of about $20,000. Well, that's not too bad. I mean, you've just saved a lot of money in taxes just simply because of that depreciation deduction. However, with cost segregation, by front loading, we'll get into the numbers shortly, we're able to, in the first 5 years, typically double or triple that $30,000 deduction so that you will have literally no tax liability left, again, during those earlier years. So the whole strategy of cost segregation is by, and we'll get to how this works, but essentially what we're doing is taking an engineering study of the property. Okay, similar to an appraisal. When we think of an appraisal, you get someone come out there and they're looking at taking pictures and measurements and everything like that, and making a laundry list of everything that's in the property and all the details. So too, we're doing that, but we're just applying. Our engineers are applying the tax code to that. And the tax code, there's something called the cost recovery system or the MACRS, right? That system delineates every single type of property that there is, every single type of component or asset in a property, and says what the useful life or the lifespan is. And a large amount of things are going to go on these faster depreciation schedules. So imagine like this, you have this pool of potential deductions that you can take over a 27.5-year period. And instead of waiting and just taking a little bit every single year, you can pull from that pool and take a large amount sometimes, and we'll get to the real numbers, but something's up to 20 or 30% of that over the first few years, or even in the first year. So that's really the benefit is. We're breaking out these individual components, showing what their shorter lives are, and then accelerating those tax deductions and getting you more cash flow. Simply put, that's in a nutshell how depreciation works. How cost segregation works. So here's, and someone had a question? No? Okay, that's when I had their mic on there. How this is an example, okay, taken from our case study, what we're going to get to later on. I don't know if you can see this too well, but these are examples of these different categories. So again, we always have land, which doesn't depreciate, and then you have the building, the structure, and that's what depreciates on that 27.5-year schedule. But what's, the structural components, that's like the walls, the foundation, the roof, windows, doors, and then infrastructure like plumbing and electric. But everything else can actually be identified and depreciated faster. So things that are called 5-year property or personal tangible property, this can include stuff like building mounted signage, right? You would never think about building mounted signage, but these are actually categories and terms from the tax code, right? But things like, right, equipment and furniture and appliances, right? We all understand those things are movable, tangible, but things like moldings or millwork, you may not think, or carpeting or vinyl flooring, all of that actually depreciates on a 5-year schedule as well. So by identifying all of that, and cabinets, countertops, we're able to identify what those things are, how much of them are in the property, and then what the value of those individual components are, and then take those tax deductions at that faster rate. So again, this is going to increase your cash flow. And again, the third category here is the 15-year land improvements. And this can include anything like concrete, right, fencing, landscaping, et cetera, all these different things that are outside. Remember, land doesn't depreciate, but what's on top of the land does. And so you can have tons of stuff, especially like in a multifamily, garden style apartment, like the ones that you guys buy, huge amounts of parking space, right? Huge amounts of, landscaping. Maybe you'll have a swimming pool or, lounge chairs and things like that. All of that is considered 15-year land improvements. And the reason why this is so important, you're thinking 15 years, that's a long time also, right? It's faster than 27 and a half, but not so fast. Well, guess what? With bonus depreciation, as we're going to see shortly, you can actually get that in the first year, all of these deductions. Okay, so this is just kind of breaking down how conservation works. We're going to get into the nitty gritty of it with the case study. But a lot of people ask, well, how much actually are we going to get in these tax deductions for different types of properties? And can you do this for everything? Yes, you can do a conservation for every type of property imaginable besides for your personal residence. Okay, so you cannot do this for your personal residence, but any business or investment or rental property you can do this for. And why I say business property, does anyone here know someone who happens to own a property that their business owns, but they're not necessarily real estate investors? Like, think about a doctor or a dentist that owns the office that they practice out of, maybe rent some other space to other tenants, but maybe they just take it up on their own. Or maybe a manufacturer or a company that has a warehouse that they store their products and goods in, or manufacturing facility. So they can also take this as a business deduction depreciation. So really important to know. Obviously, it's not just for passive investing, but apartments typically have a large amount. On average about 27%. On average, certainly some can be less, some can be more, and that will get you, meaning from the purchase price after we subtract land, about 27% on average can be accelerated, that depreciation. Okay, so we'll get into the numbers shortly, what that actually looks like. Short-term rentals are also a huge one, about 30% on average. Grocery stores, hotels have a lot of equipment, a lot of furnishings. That's where you're going to get more. Offices, a little bit less. Warehouses, a little bit less. Mobile home parks, as you can see, really off the charts, because essentially all you're buying is the land, but the land improvements, what's on top of the land, and that's the majority of what you have there. So mobile home parks can literally be 50 to 80%. So a large amount there. Okay, so so let's see here. So just to recap here, what we're doing is we're reducing our tax liability. Remember, we're not necessarily getting a cash refund. Okay, what we're doing by taking these accelerated deductions, we're reducing the tax liability during the earlier years, which in turn increases cash flow. More cash flow means more money to reinvest. That's the time value of money. Having this money now instead of 5 years from now. Think about this. We all know what inflation is doing to our country right now. Having money now where you don't actually have to pay the taxes. Every accountant that I've ever spoken to who's savvy accountant has told me that the first thing that you always want to see is how many things can you defer? How much tax can you defer, right? Think about that. Don't think about paying now. How can I get to that later? Because who knows what's going to be later on? Maybe later on you won't have a high tax rate. Maybe later on you'll have other losses or other deductions. Right now, how can we defer? Then what can we deduct? Okay, so these are the two most important things, because the time value of money, your cash that you can use to reinvest, that's probably the most important thing. So I see someone here put in the chat, can you apply this depreciation to ATM machines in the first year? Yeah, absolutely. ATM machines are not really real estate, and so they're not property per se, but lots of equipment, and things like that you can take depreciation the first year, ATMs included. So it's different than property real estate, where we actually have to do the conservation to break down those components into their different lifespans. But if you buy a piece of equipment, or like an ATM, or you buy like, a tractor, that can be fully depreciated in the first year. There's no cost segregation necessary, because again, we're not breaking out. Think about segregating. We're breaking out the cost into different categories. I see someone else sent me a message here. Non-owner occupied single through 6-unit properties can be cost segregated as well. Any types of property, single families, absolutely. Any type of property can do cost segregation. So let's move right along here. And we got, and I have a lot of clients right now who are using short-term rentals. And I'll talk about that in a little while. There's a special benefit with regard to short-term rentals. I'll talk about that when we get to the real estate professional status. But tons of people doing these Airbnb, short-term rentals, single families, just getting huge amounts of tax benefits there. Sorry, make sure everyone's on mute. Please mute yourself if you joined late. Awesome, great. So you got a lot of people joining here, so I'll just keep going. But guys, if you have joined late, please do not hesitate to ask any questions. We are very friendly here, and if we don't answer now, we'll answer at the end. But I like to take answer questions in the middle, because it just keeps you guys more engaged. So let's see here. Who should be doing? I'll ask the questions now. Who should be doing a cost segregation study? Anyone know? Can anyone do it? The answer is yes, anyone. The only one who can't is if you are not if you're a government entity, if you're a nonprofit, if you're non-taxable. And another really important type of investor who cannot really benefit from cost segregation is if you are investing through a retirement account. And this is very common, right? If you are self-directing your 401k or a Roth IRA, they call them qualified retirement plans, right? Those things are already tax shelters, and therefore can't benefit from the depreciation. If you have a huge amount of investors in a syndication who are doing that, it may not be beneficial to use the cost segregation, because again, those investors won't be able to benefit from it. Certain types of self-directed IRAs can benefit. You're still going to have the UBIT tax there, but it still can be beneficial. So again, there are different types of retirement accounts. I highly recommend you checking that out, but just know when it applies, when it doesn't apply. But it doesn't matter if you own the property on your own, if you own it through an LLC, if you own it with a corporation, a partnership, anytime. And very common with syndications, you will have general partners, limited partners who invest through a tenants in common, or who invest through an LLC, and everyone will receive their depreciation according to their percentage of ownership. So if you invest in a syndication and you're getting 5% of the total equity of the property through your investment, that means you will get 5% of the depreciation that is passed through. Okay, so if there comes through $1 million in depreciation, right, your 5% is going to get you $5,000. How much is that? $50,000. So yeah, definitely really important to see a few questions over here. Should we take them now? Does it also apply to long-term single-family home rentals? Yes, Kinara, it can apply to long-term single-family home rentals. However, I will point out shortly when we get to the real estate professional status, it may not be so beneficial for long-term rentals, because usually the depreciation for long-term rentals, regular straight-line depreciation usually wipes out any income that you have, since most long-term, short-term, why am I saying long-term, short-term? Long-term rentals don't really cash flow so much, right? And so therefore, the regular depreciation deduction is usually going to be enough to wipe out all that cash flow. So unless you're a real estate professional, it's probably not going to be so beneficial. Okay, so now we're here, the real estate professional status. This is going to open up a lot, guys, right when we get to this. And I see there's some questions here already about passive investors, W-2. Let's check this out. So hopefully this page is going to answer some of those questions already. And if not, we'll get to them. First definition, this is taken directly from the IRS. What this is when you file your tax return, you have a line that asks you for your occupation. If you write real estate professional, that means that you are defined as follows, that either you or your spouse spends the majority of your time, right? More than half of the personal services performed in the trade or business, materially participating in the real estate, real property trade or business. So what is that? again, this is a real property trader business: developing, redeveloping, constructing, reconstructing, acquiring, converting, renting, leasing, operating, managing, or brokering. Only these things, and these things only, can be determined, and this can include a lot. Renting, leasing, operating, managing can include a lot of different activities, but again, it really means that you are owning and managing your own properties. That's essentially what this means. Brokering, it just means that you're a real estate broker or realtor. You are automatically a real estate professional. However, you're still going to need what's called hours of materially participating in the real estate. And this is something that throws a lot of people off. So two things. Number one, more than half of your personal services means, okay, you would think, right, it means, okay, if I spend 40 hours a week in my W-2 and 41 hours a week on my 30 rental properties that I own, right, fixing everything, then I would qualify, right? Wrong. Unfortunately, the IRS doesn't see it the same way you and I would, right? With logic. The IRS doesn't necessarily see things with logic. They say it's not possible for someone to work more than 40 hours a week, so you must be lying, right? Either you're not W-2 or you're not managing your properties, but it's impossible. Essentially, if you have a W-2, you cannot also qualify as a real estate professional, okay? That means every single court case that has ever been brought up in tax court where people have tried to claim that, it's been overruled and thrown out. So even though the definitions here says more than half your time, I'm telling you, the reality is you cannot have a W-2 and also be a real estate professional. However, your spouse can, and that's the great thing. If you're married, of course, it's great for many reasons, but this, right, I'm not necessarily giving, marriage advice over here, right? Don't go find a partner. Maybe I actually know someone who wanted to make like a dating service, real estate professional dating service, right? If you're a high W-2 earner on one side, right? Real estate professionals on the other side, right? Let's make some matches. No, it doesn't necessarily work that way. But if you are a higher W-2 earner, your spouse is a real estate professional or vice versa, then you can bet. Why is this so important? Why are we talking about this real estate professional status, you may ask, okay? This is why. Depreciation is considered a passive deduction, okay? Rental income, your real estate income, if you invest in real estate or you own properties, all of that income is treated as passive income, even though you may not think it's very passive, but it's on your Schedule E on your tax return. It's in one bucket, passive income. Your W-2 or any other services, 1099, that's considered active income, Schedule C. You cannot use depreciation, which is a passive deduction, to offset your Schedule C, your active income. It only goes to offset your passive rental or investment income. And this is really important. So for everyone, that's how depreciation works, except for this real estate professional. Okay, if you're a real estate professional, you don't have that limitation, meaning your depreciation can now be used not only against your rental Schedule E income, it can also be used against your Schedule C or W-2 or your spouse's W-2 income. That's why this is so important, because otherwise you're right. Using cost segregation is really great to get all these deductions, but if you can't use those deductions, they're not really so great after all. Okay, you will create big passive losses and they will help you in the future. And that's really what I want to talk about a little bit for passive investors, because for passive investors, if you're not a W-2, then all this extra depreciation is going to create this passive loss. Well, that's great because essentially any earned income you have from your rentals or your investments is going to be wiped out, right? You won't be taxed on that income, and you'll have an extra loss that you can carry forward and you can use at the time of the sale as that passive loss can actually help to reduce your capital gain or your passive gains on the sale. So there is a benefit during this year for the income, and also the benefit on the sale for using those passive losses. So I'm going to get to a couple questions here in the chat. There is there's actually a couple exceptions. One exception is if you make less than $100,000 of adjusted gross income, you can take $25,000 of these passive losses to offset your W-2. And this phases out up to $150,000. So if you make more than $150,000 of adjusted gross income, you cannot use any of these losses, like I mentioned. But between that less than 100 or up to 150, you can take some of these deductions against your W-2. Okay. The one other exception is short-term rentals. as I mentioned earlier, if you self-manage short-term rentals and the average stay is less than 7 days and you only spend 100 hours a year, right? You can still have a W-2 job, but you are spending about 100 hours a year and more time than anyone else. You can actually then use these depreciation deductions to offset your W-2 income as well. So that's another benefit. So again, the two exceptions are less than $100,000 adjusted gross income or short-term rentals. Okay, so let's get to some of these questions in the chat. I see there's some people in the waiting room there also. Trevor, there you go, you got them. So let's see here before we move on with this to the case study here. We've got some great questions here. Charles asks, a passive investor in a multifamily for 100,000 investment, I may get 75+% of bonus depreciation because the lender does not get any. They're split among the investors. Yeah, excellent point. Your depreciation, I'll kind of break that down and explain that for anyone who didn't understand the question, is depreciation is based on the purchase price, even if it was financed, right? The purchase price determines what your depreciation is. So let's give a quick example. If you buy a property all cash, okay? All cash, $1 million property. And we're able to take 20% of that as what's called bonus depreciation. That means that faster depreciation that we're going to take in the first year. That's called bonus depreciation. Actually, that's the next slide over here. Bonus depreciation. So let's talk about bonus depreciation first, and then I'll explain Charles's question. Bonus depreciation means, and this was introduced in 2017 in the Tax Cuts and Jobs Act, that says that once you've done a cost segregation study and have determined all of those things that depreciate faster, remember, let's go back to the slide with the 5-year property, the 15-year property, right? All these stuff that depreciates faster. We've said, oh, this is about, let's say 20%. We said 27% on average, but let's keep a round number. Let's say 20% of the purchase price, because again, we're going to allocate land, doesn't depreciate. $200,000 or $1 million property can now be spread out instead of just over 5 years, can take it upfront in the first year. Okay, that's what bonus depreciation is. Next year, it's going to start to phase out, okay, which means it's going to go down to 80% and by 20% each year after that. What that means is, now let's go back to Charles' example there. If I buy $1 million property and I buy it all cash, okay, and I get a $200,000 bonus depreciation, meaning I can take that accelerated depreciation the first year, that means that I get 20% of my investment, right, back as a first year deduction because I paid all cash $1 million and a 20%, $200,000 deduction, that's 20% of my cash investment. However, that same $1 million property, if I bought with a loan for an 80% LTV, little aggressive, not giving advice here, what you should do, what you shouldn't do, just illustrate an example. And you bought that with a loan of $800,000 and you only put in, right, you or investors together put in 20% down payment, $200,000, and that same property gets $200,000 of bonus depreciation. Well, now you have taken what people like to say, 100% of my investment is now being reflected with that bonus depreciation. Okay, so that's how, and Charles said 75% because not everyone's taking an 80% loan to value. Some people are taking more 70% or 65%, which is going to change the amount of depreciation you're going to get per, right, proportionate to the investment that you put in. I hope that was clear. It's a little bit confusing and there are some other factors in there, but that's a really, really important thing. You may see some investment offerings saying, we're going to get 75% bonus depreciation per investment, or 65% or 100%. It's a little confusing if you don't know what that means. But essentially what it means is, like I said, based on your investment, how much of the depreciation are you going to get back in the first year? And then what that actually means to you is going to be different for every person. So then Dendon asked a great question here about will costing beneficial. Someone W-2 making over 160 on his multifamily. Follow-up question. My spouse qualifies. So I hope I answered both of those questions. Yeah, and does managing a property manager count as managing? That is an excellent question. Managing a property manager does count as managing, but it's going to be there's going to be some limitations there, right? If you're not actually doing any of the actual work, asset management, right? That is going to be included there. However, you have to actually own the property. That's something really important. Just being a property manager for someone else, unless you actually own some of that real estate itself, is not going to help you So that's a really important distinction too. Okay, Canary asked, does time spent networking and going networking meets like this one qualify for the time spent? Some of it can. I would just consult with your accountant how much of that you're actually able to write off. If it's really educational and it's specifically for your business, then it is much more likely the time spent. However, if it's just networking events, usually not. Okay, so there are some distinctions there, but again, check with your accountant how to calculate those things. And then Wakuna asked, how does the QBI deduction work for real estate investors? Qualified business deduction, I think that's what you're talking about. That will apply if you have a business, right? You can have a QBI, which essentially is about a 20% deduction right off the top. So a little bit different here, but yeah, that can actually help you as well. Okay, so moving right along, I think we're up to when is the best time to get this done? And how are we doing on time, Trevor? I'm not really paying attention.
We're doing good, yep.
Okay, and keep the questions coming, my friends. This is great, and great to see a lot of familiar faces popping in here as well. All faces and names, because not everyone has their screen on. But great to see you all, and hopefully we'll chat shortly. So yeah, let's jump in here. When should you be doing this? Most people like to get this done right at the beginning, right? First off, buy a property, get the costing done, get it out of the way. The reason for that is because the main benefit from the cost segregation is going to be on the acquisition itself. If you buy a $10 million property and you can get 20% of that right away, that's going to be a huge benefit, right? However, when you do a renovation, you can do a supplemental study. And that's really important because any money that's spent can be depreciated, okay, and added to your depreciation schedule. And some of those costs can be broken down into different categories. However, just important to note, if you get your property reappraised for a higher value, that does not change your depreciation whatsoever. Very common question I get: what if I, bought it really inexpensive? Someone bought a property totally for like $80,000 and put in, some money into it, and now it's worth $500,000. Like, that's incredible. Right? That was a really distressed property. You did a great job, but unfortunately, for depreciation purposes, it's not going to benefit you because it's only based on the purchase price. The only time that changes, again, is when you add money in. If you add capital improvements, that renovation money can be added to your depreciation basis as well. You can do a follow-up, what we call a renovation study. This can also be done on a property purchased in a previous tax year. So let's say you didn't do a cost segregation, you didn't know about it, or you just decided it wasn't a good time to do it. But this year, you're like, hey, I have a big tax liability, or I have, a capital event where I'm going to have a lot of gains, capital gains. You can use depreciation, those losses, to offset those capital gains from real estate. And so therefore, you can actually do it this year. And this is done without amending previous year's tax returns. You can basically just catch up whatever depreciation you missed that you could have taken. So we always like to run, and Trevor and James can comment on this, we like to run a free, what we call a feasibility analysis, which is like an estimate essentially to show you upfront what our projections would be. And most companies will do this and provide the numbers so you can have a good idea of what you're getting into, what the real benefits are going to be before, spending a dime and getting anything done. And so, yeah, you can do that at any point, like, just under contract, or you're just looking at a property, like, hey, what would the numbers be here, Yonah? And we can run those numbers for you. And then, so I guess we're going to jump in right now to this. So 302 Kenton J, I think that's your name, right? If I was pronouncing that correctly. That's like an acronym for something. No, but how far back can one go to look back? You can go back as far as you want. There's no limitations. However, it really doesn't make sense to go back too far. Probably over 5 to 6 years, maybe more if it's a larger property, because once you've already depreciated a large amount, there's not a lot to kind of work with to pull from that to catch up. So again, most properties, 5, 6 years is really, a good idea. If it's more than that, it would really depend on, again, the size and the type of property, how far back you can go for the look back. But excellent question. So this is a great story over here. Someone purchased a property for, 1.75 million, beautiful property here. Again, 32 unit. This was a few years ago, as you can tell, because nowadays 1.75 million probably buy like a duplex, right? But this was a few years ago that he bought this in North Carolina, and it was after many single family residents. The reason why I'm saying this is because this individual ended up selling off all of his single family properties, but was not able to do a 1031 exchange. Okay, 1031 exchange would allow you to sell one property, and instead of selling it through a regular transaction, exchange it for another property or other properties and defer your capital gain tax, defer recapture tax. However, he wasn't able to do that for various reasons, wasn't able to find the properties, et cetera. And so he was going to be hit with about a $300,000 capital gain tax bill from this event. Now, the reason why I'm saying that is going to become apparent shortly. So this property without cost segregation, remember, you can take regular straight line depreciation, would have gotten him about $54,000 of income, of depreciation deduction, which is great. But with about $120,000 of net income from this property, he was still going to be hit with, a sizable tax bill, right? About $70,000 left to be taxed, whatever tax rate he was at. And so therefore, by doing a cost segregation study, we can see the real numbers here, how we broke it down. Again, 15% we allocated to land. Land does not depreciate, but the remaining amount is now split up into these categories. After all is said and done, after a detailed cost segregation study is done, we're able to come up with these numbers, right? About $1 million and change is going to the 27.5 year. Again, remember, the majority of the value is always going to be in the infrastructure and the structural components of the property, about 72%. But the remaining 28% is going into these faster, right? 15% to land improvements, about 15-year property, 8%. And then the 5-year property, remember, that's all the appliances, furniture, equipment, carpeting, vinyl, right? Cabinets, anything that's non-structural inside, about 20%. So all in all, it was over $420,000. Well, guess what? That $420,000 was taken as bonus depreciation, and he was able to upfront write off the entire income tax liability he had, and the entire $300,000 capital gain tax that he had was wiped out as well. So there's another important thing to note. As I mentioned earlier, this can be beneficial not only for your income, for your passive income, remember, not your W-2 unless you're a real estate professional, but also can be used against other passive gains as well. So that's, in a nutshell, cost segregation, guys. This is, if you want to take a deep dive into the cost segregation audit techniques guide, you go to the IRS's website and you can learn all about it there, especially if you have insomnia. I highly recommend it. And it really, there's a lot of details that go into it. So this is not kind of a fly-by-night thing that anyone can just go ahead and do. There, requires the engineering company to go out and prepare a detailed report. There's a whole methodology, a numbering system, a documentation property, referring to the tax code, all that kind of stuff. So it is a pretty detailed